Welcome, everyone. So, as well as all of our speakers this morning, private credit is my obsession du jour at the FT, and so I am genuinely very excited to be doing this, which I think has slightly scared David over here. But what I want to start off with is getting back to the basics, which I'm sure are obvious to a lot of you, but one of the things we find with our readers is that everyone thinks they know what private credit is, but when we get to discussions, actually people get fuzzy pretty quickly. So I want to break it down and at its simplest level, talk about what it is we're actually talking about and how is it different from what banks have been doing for ages. And then also, if you can bring in kind of how has this evolved? What is it that's changed? Because this industry has just gone gangbusters over the last kind of 2-3 years. Mike, if you can kick us off, that'd be great.
Great. Good afternoon. So I've been with Blackstone now for 18 years. I know your point about simplifying what we're doing, but it is, at its very essence, it is just lending. We are lending to credit-worthy companies. The average EBITDA of our European business is about $100 million. So large, typical enterprise value, $1.5 billion. So large, high-quality, well-managed companies. I've seen the evolution of private credit over the last 18 years I've been at Blackstone, and where we first started was the lender of last resort. So, 18 years ago and through the financial crisis, it was companies that had covenant problems, had liquidity problems, maybe their debt was maturing, and they came to private credit as this very expensive alternative compared to bank financing. And they saw that the private credit firms they were working with, whether it's my firm, whether it's David's firm, were responsive, good partners. Yes, the capital was expensive, but it helped them through a very difficult situation and to the other side. And over the years, those partnerships we had with the private equity firms that we were lending to, or even family-owned companies, they wanted to do more and more transactions with us, but our capital was very expensive. And so over this period, we raised lower return targeting capital to target performing companies and to really give an alternative to these private equity firms versus borrowing from banks, borrowing from the broadly syndicated market, and borrowing from high-yield bonds. And just in terms of typical transactions, so I mentioned the $100 million of EBITDA. In the last year, we financed a few take-private transactions, but just to put in context, we were one of the lead lenders on the Hargreaves Lansdowne take-private by CVC, Nordic Capital, and Adia. That was $1.5 billion, or £1.5 billion of debt against a £5 billion enterprise value. And we were one of the lead lenders on the take-private of Decra Pharmaceuticals by EQT, again, about £5 billion and £1.5 billion of debt. So regular way lending to very high-quality companies.
Yeah, and it has to be said that earlier today I was editing a story on BlackRock buying HPS, and I had to say to one of my colleagues, no, private credit is not just lending to the riskiest borrowers, no. Nope. But so that's still, well, we're still fighting that instinct. Tell us a bit more about how you approach it and what you're doing at Cerberus.
Cerberus has been in the middle market lending business initially in the United States for nearly 30 years, typically lending money to financial sponsors. I think over its track record, we've lent to nearly 200 sponsors, typically where there's a long-term relationship and a comfort with that financial sponsor and the business they're acquiring or looking to refinance. And so we have the benefit of knowing which sponsors we find to be, let's say, more reliable and more conscientious, both in the due diligence and the management of their portfolio companies. So it's really a repeat business. And to the question you asked earlier about, well, what is the reason for this to exist? There are a number of reasons, but one of them, I think, is when people want a lender who can respond quickly and also can bring flexibility and an ability to underwrite businesses that may not have long-standing audited financials, may be going through a transition, may be going through an acquisition where the synergies have not yet borne out. There are certain types of lenders who constitutionally might be a bit more comfortable underwriting some of those risks and, of course, getting paid for it. And so I think those have been the type of situations where our lending activities have been most active. And we also are active in lending, particularly against commercial real estate assets as well.
Yeah, so but you've been at it for 30 years, so that sounds like nothing new to see here, but how has it changed in the last few years? Or is it just that you've been doing repeat business for a long time and you've developed some people you really like?
Well, I mean, over time, I think the business is obviously, it's private market lending, which is what we're talking about, has grown, and therefore people are more accustomed to borrowing from a private market lender, which could be a private equity fund, a specialized fund. And so in some ways, you know, everybody sort of benefits when something becomes more accepted and more
No longer scary.
Oh, I hope we were never scary, and if ever we were perceived as scary, I'm not sure it was justified.
Okay. David in the middle, David. What do you kind of see as behind, you kind of see this from a slightly different side of things. What do you see as driving the rise in private credit in the last, well, couple of years?
I think there's several factors, and we heard this morning from Venkat, for example, who, you know, talked about the future of the banking sector and private credit working hand in hand in a symbiotic way, which, you know, he called it out himself. Yes, there is a regulatory arbitrage. Sometimes we don't like to talk about that, but it's fact, is that, you know, he talked very extensively around, you know, they are regulated because they need to be regulated because they're holding retail deposits versus these guys that don't. And these two worlds can coexist. So there's definitely a regulatory arbitrage piece which we should all recognize. So that's one factor. But I think that, you know, I think there is a growing realization that as you have, there is a wider ecosystem for everyone to work together here. And particularly when we talk about, and was mentioned in the introduction, we talk about capital velocity, which is becoming more and more important for banks, who are able to recycle their capital and balance sheet. And I think that becomes an important factor. So when we talk about banks potentially losing income by the, you know, the introduction of private credit into space, the reality is there's an opportunity to recycle capital and continue to make fees, et cetera, and to maintain customer transactional relationships here. So I think there is this desire to move balance sheet much faster than what has historically been the case. So I think this is part of the drive as well.
Yeah.
And the reality, these guys have raised a ton of money, right?
They need to put it somewhere.
I guess what you're comparing, though, is often it's the private credit versus bank on balance sheet lending. And I think what's interesting about private credit is private credit's taken a lot of share, both from the banks that way, but it's taken share from broadly syndicated loans and high yield bonds. And I know I'm very biased in saying this, but the reason it's taken share, I believe, is that it's a better product for the borrower, and it's a very good product for the LP as well. And from the borrower's perspective, you always need to put yourself in the shoes of the person who's choosing what debt they want to use. So if you're a very sophisticated private equity firm, you typically have someone dedicated to getting the best capital for your businesses. And best doesn't always mean cheapest. Best could mean most flexible. Best could mean having committed acquisition lines. And private credit brings to the borrower certainty of cost of capital. So when a bank does a bond or a broadly syndicated loan, they have an underwrite, and that underwrite doesn't give a guarantee of what the cost of capital will be. It gives a range of what the cost of capital will be. So it doesn't give certainty. It doesn't give, I mentioned committed acquisition lines, things that are very important to private equity firms when they buy a business, often is to make an acquisition-led strategy. We don't require a credit rating. We do the credit analysis ourselves. And so all of this leads to, another point would be that when you're the borrower, you know who your counterparty is in the debt. And that is the way banking used to be when the banks held the loans long term. But in a high yield bond or broadly syndicated loan, you know who your borrower is day one, but that debt will trade away. And in a distressed time or a COVID or whatever happens to be, you don't know who holds that debt. So there's benefits to the borrower, and they need to decide, do they want the cheapest option, which could be the bond or the loan, or do they want the best option for that deal? And then from the LP's perspective, they're making a decision of the type of capital, where they want to lend money, and they see the premium in private credit. And part of that is attractive loss ratios. Part of it is, I think, a better diligence process where we're private alongside the buyer of a business, takes several months versus a shorter term bond roadshow. All these things, better workout teams, all these things can lead to a better result for the LP and a better result for the borrower. And that's led to a big rise in the share that private credit has in the market.
David in the middle here raised one of kind of the critiques and about regulatory, whether this is just regulatory arbitrage, and we can come back in that in a minute. But another one, just in response to you, Mike, that we hear is that, maybe private credit firms aren't going to be as willing to work with borrowers when stuff goes bad as banks are, that it's not so much in their interests. And, this stuff isn't as tested in the new era of interest rates that we've kind of entered into. And David, I want to bring you in on this as well, but how do you, I don't know if you want to come here, otherwise we can go back to Mike, but how does this
You're the
kind
moderator,
of
whatever you prefer.
Go on, I'm not going to make you uncomfortable. Go on, David. It's not like Mike hog the stage.
Okay, well, I think we can each hold our own in terms of willingness to take the mic. I think that he made a very good point, and both of our firms have strong operational capability which can help support a business if and when it runs into difficulty. The other thing is that a traditional lender would not typically put new money in a circumstance where a bank has difficulty. So the combination of having, I think, financial workout capability, which banks also have, but really the flexibility to look at the circumstances of a business, offer operational support, but also, in certain circumstances, offer additional money, hopefully not good money after bad, but money to help a business when it needs additional working capital, which is not what a bank is set up to do, actually puts the borrower, I would argue, in a better position to sort of get over its challenges, whether or not those challenges are COVID, which many companies obviously suffered from, or more unique circumstances facing the business. So from my perspective, I would actually argue that if a business runs into a challenge, being able to access the lender who they know and who they chose to borrow from, rather than a lender who ultimately syndicated a loan, would allow for faster decisions in terms of waiver of covenants and things like that, and getting support that they would not otherwise be able to access.
Mike, you seem like you want to jump in again.
I would completely agree. I mean, we're trying to build a long-term business where the biggest and best private equity firms choose to borrow capital from us. And if every time there was a difficulty in one of their portfolio companies, we did something that was, irrational, aggressive, opportunistic, didn't support the companies, we would not get future deal flow. And we need to balance for every deal acting in the best interest of our LPs and focusing on that transaction and making sure that we manage the risk and mitigate risk for our investors in that transaction. But we also want to be viewed as an important, trusted, long-term party of everyone we work with.
Sounds like we're in cuddly capitalism central here.
It's a real balance, right? It's really important that the borrowers we work with view us as the strategic long-term partner of their business and someone that can grow with the transactions they do, whether they're big transactions, small transactions, and that when they have challenges, we have operational expertise to help. Now, many of the private equity firms we work with also have operational skills, and they don't need help many times, but it's often if you do have a situation that you have challenges and we can bring in resources, that's really valuable. I think Blackstone has, I would view best-in-class cybersecurity expertise, things like that, where a portfolio company might have an incident and we can help out and add value there too. So it is a long-term partnership between us and the borrowers.
And I'm pleased you use that, because that enables us to see seamlessly to all of the partnerships with banks, because that's another area where it seems like everyone is saying, look, isn't this wonderful? We are partnering with a bank to, well, you tell me, to launch some kind of private credit partnership, and you can explain to me exactly how those operate and what kind of there is to gain on both sides. And how exactly that works. But I want to talk about that and then a bit about whether banks actually still stand to lose quite a bit there. Let's talk about how these partnerships work, and then we can maybe talk about how those relationships end up changing the model for banks, I guess, more than you guys on your side of the fence. I'm going to come to you first on this, David.
Sure, and look, perhaps it is a change in the model, but I think, as I said earlier, and as was reflected in the discussions this morning, I think it does become an interesting symbiotic relationship between private credit and the regulated banks. The banks obviously have extensive distribution network. They own client relationships. That is something that private credit operators can jointly work with those banks to mine those relationships. That these guys have their own relationships, but it's not as diverse as the banks have, so it provides more opportunity for them. And again, it comes back to greater volume of being able to put through this joint relationship. So whilst the banks may be giving up fees and interest income from the lending they would have otherwise done in these situations. It can become a volume play. They can continue to participate. They are able to provide senior leverage into these situations. And as I said earlier, they're also able under these constructs to maintain the transactional customer relationship, which continues to benefit them as a broader bank. So I see this in many ways as a win-win. Then you bring in the private credit side, and as you guys are saying, the flexibility that brings, the capabilities that bring to a certain lending situation that may not otherwise happen if it was left to the bank alone, right? So I think these two things coming together can become extremely advantageous for both sides. And therefore I see, well, we heard it this morning from Tanji from Standard Chartered, saying this is the future as far as they're concerned around these types of partnerships, and the same thing from Venkat. And as you pointed out, there is a whole bunch of these now more formalized JVs, partnerships that are coming into play, because I think everyone now sees this as a big opportunity to grow the space and benefit from each other.
I think the thing that I have to kind of grapple with is kind of whether long-term private credit, just because it's been on such a kind of exponential growth mode in the last couple of years, what stops it from eventually just eating the bank's lunch entirely? So it's, takes a bite here and a bite here and a bite here, and, eventually it becomes so big. We've seen kind of Apollo, who are one of the kind of pioneers in this space, really kind of, I think, changed how I thought about it when they put out a set of targets in October, which just set out the scale of the opportunity and how big they wanted to become. And it was truly kind of staggering. But with that, we know that in the private capital space more broadly, there is huge ambition, and Apollo already kind of rivaling the banks in the amount that they're generating. What stops private credit from really just taking, chunk after chunk after chunk of business from the banks? And maybe you don't mind. You'd be quite happy with that.
So I would start by saying the banks are providing client service in the form of M&A advice, IPO advice. Those are things that the private credit world does not do. The private credit world wants the assets, not the clients. And so you're seeing these partnerships form because the banks have broad origination networks. They have industry bankers around the world that cover both private equity-owned businesses, but also public companies, private companies, family-owned businesses. And there's an access to the decision makers at those firms for capital needs that the private credit firms don't have. And the private credit firms on the other side have the assets, they have the capital, which these companies need. And so whether it's in a form of an official partnership or just in the form of just day-to-day business, we, the private credit firms, are a very important counterparty of the banks because they want to deliver a service to their client. And that service could be, it could be a bank-led loan. It could be a broadly syndicated loan where, again, they're selling it down to an institution. It could be a high-yield bond that, again, goes to institutions. And so working with private credit, you're just delivering another form of capital to help the banks service their client. And the banks will earn a fee, whether it's a debt advisory fee, whether it's an M&A fee, or something else. So there's value to that. I think the challenge with any partnership, and you mentioned one of the partnerships, is that when you get very close to one institution, that often means that there's an advantage there, but you're going to have a disadvantage that other institutions may not call you first because they know you have a partnership with whatever that private credit firm happens to be. And so there's pros and cons to this, and clearly some of our competitors have weighed up the benefits and drawbacks of doing that and have decided to go ahead. I think you'll see us go into partnerships in spaces where we don't have the natural origination, whether that's in asset-backed, whether that's in smaller companies. There's things where we don't have the origination and we can benefit from the banks that way. And then in many situations, just whether it's the balance sheet heavy banks or the advisors that don't have balance sheets, they're constantly working with firms like us just to deliver assets and debt financing to their clients.
I want to come back to a point that David talked about earlier about regulatory arbitrage and whether private credit is just kind of regulatory arbitrage and that's what's driven it. And I think Mike has made some consistent arguments about why it's not David, I want to come to you. Do you think this is just a giant regulatory arbitrage?
I didn't hear him say that it's regulatory arbitrage.
I said it was part of the equation. It's not the whole.
No, I don't think it's regulatory arbitrage. I think there's I think that, banks are subject to, let me say, significant capital requirements, reporting requirements. There's a lot of things attendant to being a regulated bank, and I think it's a potentially a virtuous partnership where banks who want to go a bit more balance sheet light can reduce the risk density in connection with, extending credit by back leveraging loans which the private credit sector makes, or reducing their hold, because banks, even with large capital positions overall, they still have maximum holds that might be, let's say, 100 million, 150 million, 200 million, depending on the size of the bank. So for them, I think having a partner who can come in who basically takes more of a junior piece and they take more of the senior piece, for example, is helpful. I don't view that necessarily as arbitrage. I look at it as ultimately the bank's trying to maintain the client relationship, the fee business, the high ROE activity, and bringing somebody else in for the higher risk density, lending the capital part, so they have a bigger margin of safety, and they're working with a partner who can be responsive and also, frankly, is in a second pair of eyes trying to help underwrite the credits. So I think arbitrage is frankly not the way that I would characterize it.
I've never heard anyone refer to high-yield bonds or syndicated bank loans as being regulatory arbitrage. And what we're doing is just, it is an alternative for the borrower to high-yield bonds or syndicated bank loans. And the borrower has a choice of, when they look at each of those types of capital structures. Again, you talk about the Decker transaction, the Hargreaves-Lansdowne transaction. The borrower had a choice of how they finance the business. And for £1.5 billion of debt, the banks typically will not take that size of debt as a take-and-hold transaction. They underwrite to distribute. And underwriting to distribute, either in a high-yield bond or broadly syndicated loan, typically is your cheapest cost of capital, but it does not come with the flexibility that, again, I mentioned the certainty of cost of capital, the committed acquisition facilities, all these different things, the partnership with who your borrower is, that one-to-one relationship versus a high-yield bond where you know your lenders day one, and then you have no idea when your results are challenging, when the market has an issue. And so all of these reasons add up to why the borrower says, I would rather pay a premium to have that partnership with who my lender is, the expertise, all the different things we can bring to the table. And so that is not regulatory arbitrage. That is just someone choosing a different and what I think better capital structure for the companies that they own. Yeah. And so that's why you're seeing this continued taking of share by the private credit market.
So let's say that regulatory arbitrage is a misunderstanding of kind of the drivers of this market. I feel like the other way that kind of the instinct that we kind of get a lot at the FT about how people talking about private credit is that there must be something wrong here. There must be some kind of systemic risk, or for some reason we don't understand, it just kind of smells wrong. Why are kind of the various systemic risks kind of unfounded? Why, I realize I'm asking a bit of a negative here, but David in the middle, maybe you can speak to, why, do you have any view on why it is you think that people get worried about this, and why maybe if there's a grain of truth to that, or if it's just everyone going, don't really understand this?
I don't think there's a grain of truth to it. I come back to what Mike said right at the very beginning, and certainly Cerberus has a heritage here as well. These guys started in a world, as you said, lender of last resort in many cases, right? Into situations that were perhaps a little hairier than what banks were willing to tolerate. Originally, this is where it all started. So the legacy or the heritage of most of the private credit firms or private equity firms is in dealing with complex situations that require deep underwriting capabilities and skills down at not just at a financial level, but deeply at an operational level. So to your earlier point, the level of underwriting that goes on in these situations is very intensive. So the idea that this is a light touch underwrite that is less vigorous than what would otherwise be in the regulated banking sector, I think is completely false. I think the fact that there is lending taking place outside of a regulated environment, just for whatever reason, sends off alarm bells. But I think it's a bit of a dog whistle.
It's the idea that risk is moving off balance sheets, or that
Right.
banks are still involved in other
And
ways.
it's moving because of the reasons that are being mentioned, right? It's not because, these guys over here will be much friendlier to me in the underwriting process. In fact, the reverse is probably true. I think it is getting a deeper understanding, having come from that heritage and being able to understand the risks that are being underwritten here is a skill set that sits within private credit.
And then I think the other layer where people are still getting to grips with it is kind of where the lending to the private capital firms from the banks comes from, like what those various linkages is. And from our side of things, it's pretty opaque at the moment. I think the regulators have also said we think it's pretty opaque and we don't know how it works. Is that a reason for concern? Want to take that one?
Is it me, David, and then Senator David?
David T, David E.
Either way. Look, from my perspective, no, because the banks are underwriting the loans they're making, and they're making loans oftentimes against a portfolio that has diversified risk rather than the unique risk of back leveraging an individual loan. I'd also point out that the funds to whom they're lending money are typically borrowing, let's say, 1-to-1 or maybe 2-to-1 against the loan, whereas the bank itself, if they were to extend credit to that same borrower, might effectively be extending credit depending on the rating, the internal rating, the risk-weighted assets, and in turn the capital ratio of the bank. They may be lending at, let's say, 7-to-1. Okay, so you're actually, in a way, introducing less, I would argue, less leverage in the system, taking this approach.
I would add the structures that most private credit loans are held in. Again, private credit is a broader universe than what I'm referring to, more about just direct lending, so the corporate acquisition or refinancing. These structures are either permanent capital, so you have some of the public BDCs in the US where capital is raised and can't be redeemed at all. It's permanent capital. And then you have, that's on the equity side of those funds. Then you have some semi-liquid funds that have redemption caps that, again, control the capital within the fund. And then you have the drawdown institutional, similar to a private equity fund, drawn over several years, held until those assets are realized. And many of these vehicles are unlevered, or the ones that are levered often are about 1x levered. And the leverage is matched to the length of the assets in the business. So you think about the mismatch, and the challenge the banks have is between short-dated liabilities and their deposits versus the long-dated loans that are underwriting. And for the private credit structures that we and many of our competitors are using, again, either unlevered or modestly levered with one turn of leverage, and the assets and the liabilities are matched and long-dated in nature. And so for me, that gives a lot of comfort around how these structures are set up, and to make sure that for our investors, who again are sophisticated institutions or high net worth individuals, that they're getting a very comfortable structure as to how their assets are held.
I want to throw it open to the floor at this point. Can we get a microphone? I'm going to go there first, and then here.
Hi, Michael Sparks, BMY. Spoken about the massive expansion in capital into private credit. To what extent is operating capacity a concern for the industry? Have you been able to ramp up resources to facilitate the kind of underwriting and more detailed process that you're bringing to bear? And how should we think about that if we continue to see growth at the rate we've seen in the last 5 years?
I can start by saying, so the rise of capital raising on the private credit side has led to private credit targeting bigger companies. And 3 or 4 years ago, when there was $1 billion financing, that was big news in the credit world. And now you see regularly $1 billion, $2 billion, $5 billion credit transactions being financed by private credit. And what we've seen is that these larger companies are better managed, better private equity firms buying them typically, in terms of just larger, longer established private equity firms, spread across multiple jurisdictions, multiple products. So the downside of bigger companies doesn't always mean better credit risk, but typically they are better credit risks. And so as the industry has raised more capital, it is disintermediated to a certain extent the other alternatives that would be the financing choices. So the high yield bonds, the broadly syndicated loans I mentioned. If you look back in Europe, 6 or 7 years ago, if you needed more than, say, $500 million of debt or 500 million euros of debt, you had to go to the liquid markets. But because you've seen the scale and rise of the amount of capital that firms like ours manage, these companies are now choosing. They wanted private credit, but it wasn't available over 500 million. Now it is. And so those are, in some ways, easier credits to underwrite. And one more point would be that you're seeing more of the challenges in the industry across smaller companies versus bigger companies.
Your basic point is that you're doing bigger transactions,
Yes.
Not necessarily more, so your operating capacity hasn't had to scale as much as it would have done?
It is easier. I mean, the amount of work to do a $1 billion loan is similar to doing a $200 million loan, and I think your risk actually profile improves as you get bigger companies.
You still want to ask a question? Yeah, yeah.
I wanted to first of all, allay the fears of your colleagues in FT. I work for a bank, yeah, and rather than using the term regulatory arbitrage, I would say differences in risk appetite.
Yep.
Yeah. So post the crisis, as the banks have been turned into utilities, they have a different risk appetite, and therefore there's a need for players who can fill that vacuum. The question I had for you is, in terms of a private firm which has both private equity and private credit, how do they sit together in the same firm, and how does that all work?
So I guess the question for the audience is around how a firm like Blackstone will have a private equity business and a private credit business. So our private equity business is walled off from our private credit business, or just from our credit business in general. Every large private equity firm essentially comes to Blackstone Credit for financing for their acquisitions, whether that's a normal private company buying private company or it's a take private. And our business only works in the sense that those private equity firms trust that the information they share with us stays on our side of the wall and does not go over to the private equity side of the business. And then for certain funds, so we have our US BDCs, business development companies, those are regulated by the 1940 Security Act, and those cannot do affiliate transactions at all. So there's strict rules, and again, for any other funds that could finance Blackstone private equity, there's very strict rules around what those transactions could look like. You can never lead a deal, you can't set terms. All the things that are key to our business, we lead transactions, we drive the terms. So I find it very rare to work with the other side of the house. And we work with everyone else.
We've got 1 minute remaining. Any final questions? Otherwise, I'm going to ask. Do we have one over here? Go on. I think we've got the MC in the house. Yeah.
Got to have some privileges in life, haven't you? Just 3 real observations and sort of, I guess, pseudo questions. Is not the real value of banks bringing to private credit the fact that banks can back multiple bidders on acquisition situations? They can run trees where I think private credit firms may be more thinly resourced. So effectively, banks become origination units for private capital to come in. I mean, the other question I wanted to ask you is, where exactly in the capital structure are you playing? Is it mainly senior lending? Are you doing preferred equity? What's happening there? And Mike, you mentioned very clearly that you're asset-driven rather than client relationship-driven. How does that then play out when there's a really, really difficult situation? Because banks, maybe we're just too nice, but we sort of like play for the long term. How does that really play out when there's a really difficult waiver, which is being asked by your borrower?
A few questions there. I think the first one would be that for our private credit is about 160 billion of Blackstone's 1.1 trillion. The vast majority of private credit for us is senior secured direct lending. Now, many parts of private credit are also direct, where there's you're working directly with the borrower. But it is, the word direct lending is often used for sponsor-backed acquisition financing, typically about 40% loan to value through a transaction. And then about a small part of that, maybe 10% of that overall capital in the private credit side of our business would be for more opportunistic lending, which would be sometimes senior, but maybe with warrants attached to it, sometimes pref equity, second lien, PIK securities, junior. Very different risk profile, typically in a drawdown format versus a BDC type format.
Mike, there's a very angry clock in front of us ticking down.
Very quickly on the other question was there's different parts. The point about the banking disintermediation, I think the banks, where I see that role, the origination role, is often on the asset-backed side, where there might be something where the banks are actually servicing the client and keeping the client that way. On the direct lending side, the banks are disintermediated from the sense that we have the direct relationship with the borrower and the private equity firm owning the business, and it is very much in our long-term best interest to be a good partner of those who we work with.
Thanks very much, everyone. I feel like I've been safely had my fears assured for at least the next half an hour, and I think it's been a really interesting discussion. So thanks very much to everyone. Thanks to Mike, thanks to David, and thanks to David.
Thanks.